Welcome back to the Daily Nugget, daily property insights, one topic, 20 minutes or less, 7 days a week. Myself, Lawrence Lotze, and today joined by Matt Harris, a property tax specialist and a fellow property investor. And Matt, a real simple question to you today, because some people might not know this is, but what is the OCR? What is the official cash rate? What is it? And what does it stand for? And what does it imply?
Yeah, great question today. And because we use a lot of jargon and sometimes we just assume that everyone understands what we're talking about. So OCR is an acronym that stands for the official cash rate. It is one of the monetary policy levers that the Reserve Bank can pull to control lending and by default control inflation. So what it is in technical terms is the amount of money, what's the cost of the money that the banks borrow. So let me put that in a better way. It is the financing cost that the central bank charges other banks to borrow money. What it does is it directly reflects the interest rate that you charge at a retail level, so your mortgage rate. So, for example, if we borrow a lot of money as a country, we obviously put pressure on the economic system. And so at the moment, we've had record low interest rates. And anyone in the last 12 months has seen what that's done to the property market. And the reason being, it's really obvious to see why. You put money in the bank, you get a 1% return. You put in the stock market, you probably get about the same return as in property, but you lack the leverage bit that we've talked about before in these episodes. So you can now borrow, where you could borrow $1 million at the same cost as $500,000 12 months ago. So what's that done is it's put pressure on our monetary system. So what happens in response to that and the inflation that is happening in the economy at the moment, the OCR rate is increased. And what that does theoretically is it reduces demand for money because we have to pay a higher rate for it. And so that's how the OCR works. It is widely regarded as the number one lever that is pulled to control inflation. And that's because it directly affects household spending. If you have a mortgage and you're currently paying 2.5%, and that mortgage rate rises to 3.5%, you have significantly less money in your pocket, especially in an environment where the level of debt that Kiwis carry, especially in relation to property, is higher than it's ever been.
Thanks, Dad, and thanks, Dad, Matt, and I hope to anyone that was listening on this one has a bit of further clarity what it is and what it stands for and why it's utilized as well. And as always, if anyone's got any further questions for myself or for Matt, please reach out. The details will be in the description below. And as always, thanks for coming over to the Daily Nugget, daily property insights, one topic, 20 minutes or less, 7 days a week, and hopefully see you